Hey guys, thanks for clicking on this video. We're going to be looking at GameStop, but we're going to be talking about it in relation to the market crash because we do believe that these two things are very tightly linked. And one of the ways we can do this is using the Buffett Indicator, and this suggests currently that the US market is strongly overvalued. So, what is the Buffett indicator? Well, the Buffett indicator is a ratio between the United States stock market valuation to GDP, and as of August 19th, 2021, with a current aggregate US market value of 54 trillion and an annualized GDP of just over 23 trillion. This gives the Buffett indicator, if you divide the value by the GDP at 238%. So by this calculation, this is currently 87% or 2.8 standard deviations above the historical average, which suggests that this market is strongly overvalued. People can say, oh, this is historical all-time highs. Yes, interest rates are historic lows, and this time it's different, but it's never really this different. So here is a historical chart of the Buffett indicator shown below. This goes from 1950 to today's value, and you can see that this is the historical trend line. This is an exponential trend line that suggests the market value to GDP ratio should be around 120%, and currently it is at 233%. And this is the actual market value to GDP in the blue. So you can see here where I had historical all-time highs, blowing 2008 out the water. Sorry, blowing the dot-com crash, and also blowing out 2008. And you can see other crashes earlier in time. I will put the link down below, but I'm just going to touch upon some points here. So this by Warren Buffett says it's the best single measure where valuations stand at any given moment. He has walked back on this, but I imagine this is because they were at all-time highs. So to look at total market value, the most common measurement of aggregate stock value, or the aggregate value of the US stock, is the Wilshire 5000. This is an index created so that I-point increase in the index corresponds to a billion increase in the US market cap. As per Wilshire, the ratio of 1 to 1 has drifted, and the 1 point increase is corresponding to about $1.15 billion. And you can see here is the graph over time. So we are pretty jumping up at an exponential rate. GDP, gross domestic product. This is measured by the US government's Bureau of Economic Analysis, and this is a static measurement of prior economic activity and does not forecast the future or any growth. It is calculated and published quarterly, and you can see here is a graph of this. So if we look at the historic ratio of total market value to GDP, the Buffett indicator, you can see it's below, and you can see we have once again the trend line, which suggests we should be at 120%, and the current value is 233% of GDP, or 87% higher than the long-term trend line. Here is the standard deviations that they've calculated: fairly valued, overvalued, strongly overvalued, undervalued, strongly undervalued. And you can see here we have the internet bubble that just touched the second standard deviation, which was overvalued. And then on the opposite side, if you bought at the bottom of the financial crisis, which was undervalued, then that would have been a great time to buy. So this would be showing great buying opportunities as well. But you can see here we're actually touching considerably higher than any other time in history. Internet bubble, which was called the most overvalued market of its time, and we have definitely beat that. And if we just look at 1990, you can kind of see how much this has swung up and down. So in summary, the market to GDP ratio is 87% above the historical average and is now considered strongly overvalued. So that is a quick summary. We'll be talking about these other valuation tools on this website because I do think they're very good. So thanks for watching, guys, and I'll catch you next time.